Welcome to the Deep Dive, where we cut through the noise and get straight to the insights that matter for seasoned investors and, well, curious minds alike.
Great to be here.
Today, we're taking a deep dive into Crown Castle's second quarter 2025 earnings conference call that was held July 23rd, 2025.
Right. And on the call, we had Chris Henson, VP of Corporate Finance, Dan Schlangeganger, the interim CEO, and Sonnet Patel, the CFO.
Exactly. And Crown Castle, they're making this really bold bet, aren't they? Shedding the fiber business, going all in on towers. Pure play operator.
That's a big move.
But, in this shifting telecom landscape, is this pivot a masterstroke or maybe a risky gamble?
It's the million-dollar question, isn't it?
Our mission today is really to distill the key financial insights, the strategic updates, and, that forward-looking commentary from the call.
Yeah, help you uncover the numbers, the strategy, and maybe those subtle clues about whether they're actually on the right path.
So let's start with the headline. What was the immediate takeaway from the quarter?
Well, it was a strong quarter, fundamentally. Crown Castle delivered solid Q2 results. Yeah. Solid enough that they actually increased their full year 2025 guidance.
Okay, an increased outlook. That's always a good sign.
Definitely. And the key takeaway from the call was really the robust performance from their underlying tower business, that core business.
Right.
Which really underscores the operational efficiencies they've been talking about and just the continued, resilient demand for those essential tower assets.
Okay, so solid quarter, guidance up, strong tower performance. Let's drill down a bit. What were the standout numbers? And maybe more importantly, what surprised you or perhaps didn't quite meet expectations? Specifically looking at Q2, excluding fiber, which is now discontinued ops.
Well, what stood out immediately, I think, was that they delivered higher than expected results overall. That was clear.
Okay.
They hit 4.7% organic growth. And that's even after backing out the impact of those Sprint cancellations, which are still a factor.
Almost 5% organic growth, excluding Sprint. That's pretty healthy in this environment, isn't it?
It really is.
Yeah.
When you see companies struggling for growth, getting close to 5% organically, it says a lot about the demand for towers and, frankly, their execution. We also saw a $6 million year-over-year increase in services activity contribution.
Okay, that $6 million in services, how significant is that really? Is it like a strategic shift or just efficiency paying off?
Good question. It's certainly meaningful. It points to them being able to provide, extra value-added services around the towers, maybe modifications, enhancements for tenants, that sort of thing.
So not a whole new business line, just optimizing the current one.
Exactly. It's not some radical shift, but it does show their operational improvements are hitting the revenue line directly. And importantly, they managed a $37 million year-over-year decrease in SG&A expenses, selling, general, and administrative.
37 million lower SG&A. Where did that come from?
Mostly from the staffing reductions and office closures they announced back in June 2024. Those are flowing through.
Right, those restructuring efforts.
Yeah. And also, crucially, they didn't have the $20 million in advisory fees this quarter that they incurred back in Q2 2024.
Okay. So some of it's cost cutting, some is just lapping prior expenses. Still, tangible savings hitting the bottom line.
Definitely sustainable cost reductions.
Yeah.
But like you said earlier, it wasn't entirely one-sided.
Right. What were the offsetting factors?
Well, these positives were largely offset by that unfavorable $51 million impact from Sprint cancellations. That continues to bite.
Still working through that churn.
Yep. Then there was a $34 million reduction in non-cash straight-line revenues and a $16 million decrease in non-cash amortization of prepaid rent.
Okay, let's pause there. These non-cash items. Can you quickly break down what they mean for listeners who might not live and breathe REIT accounting? Why do they matter if they don't hit cash flow directly?
Absolutely. Good point. Think of non-cash straight-line revenues and non-cash amortization of prepaid rent as basically accounting adjustments. They smooth out revenue or expenses over time. EV cash changed hands differently. So like a long-term lease might have payments that step up over the years, but accounting rules often make you recognize the average revenue evenly, that straight line.
Got it.
And similarly, if Crown Castle prepaid rent for land under a tower years ago, they'd spread that expense out, amortize it over the prepayment period. So a reduction just means less of that paper revenue or expense is hitting the books this quarter.
So it reflects expiring contracts or accounting adjustments, not necessarily a change in the underlying cash generation.
Exactly. It's not about their immediate cash or operational health.
Yeah.
The real story, as we'll see, is still in that cash-generating core business.
That's helpful. So despite those accounting bits and Sprint, the updated full-year outlook is up. Site rental revenues increased by $10 million. What's driving that?
Yeah, that boost comes mainly from higher organic contribution to site rental billings, basically increased activity levels.
More leasing.
Yep. Specifically, they call that a $5 million increase in core leasing activity and another $5 million bump from back billings, collecting revenue for past services or unbilled amounts.
Okay.
So that brings their full year organic growth outlook back to that 4.7% number, excluding Sprint. It just shows sustained demand.
And it wasn't just revenue getting an upgrade, right? Adjusted EBITDA up $25 million.
Yeah.
And adjusted funds from operations, AFFO, got an even bigger lift, up $35 million.
That's right. And that AFFO figure, that's often a key metric for REIT investors.
Definitely.
And the AFFO increase is interesting because they broke down where it came from. Multiple drivers.
Like what?
Well, you've got the $10 million increase in site rental revenues we just mentioned, plus a $10 million decrease in overhead expenses, finding more efficiencies, then a $5 million increase in services gross margin.
Okay.
And finally, a $10 million decrease in interest expense, mostly from pushing out the assumed term of some floating debt.
So it's a mix. Top-line strength, cost discipline, better margins, and even some financial maneuvering.
Exactly. A multifaceted improvement.
Yeah.
Shows they're pulling multiple levers.
Okay. Now, what about spending? Capital expenditures. The outlook for discretionary CapEx stayed the same, right?
Right.
$185 million gross, $145 million net.
Unchanged, yeah. $145 million net of that $40 million in prepaid rent they expect to receive.
And what's that money earmarked for?
It's for things like modifying towers, accommodating new tenant equipment, also purchasing land under their existing towers, which helps reduce future ground lease costs.
Smart long-term play.
And investing in technology, that's a big one. Enhancing and automating systems and processes. It shows they're committed to the core assets and just making the business run smoother, more efficiently.
Which leads us nicely into the strategic transformation. This is the really big picture stuff, isn't it? Selling fiber and small cells, becoming pure play towers.
Absolutely. And management reiterated 3 clear near-term priorities on the call.
Okay, what are they?
First, meet or exceed those 2025 financial and operating objectives, which, as we just discussed, they seem well on track to do. Second, facilitate the successful close of that sale of the small cells and fiber solutions businesses. Get that deal done.
The divestiture itself.
Yep. And third, which is the longer-term vision, position the tower business to maximize shareholder value as a standalone, pure-play U.S. tower operator.
Okay, a very clear focus.
A very significant development for the company's strategy.
So on that fiber segment sale, how's the progress? What did they say about milestones?
They confirmed it's on track to close in the first half of 2026. So still a little ways out, but progressing.
Okay.
They've started getting state-level approvals, which is positive, and they're actively engaged with the Department of Justice. They mentioned getting a second request for information recently.
Is that normal for a deal this size?
Oh, yeah, pretty standard part of the regulatory review. Nothing necessarily alarming there.
Right.
And operationally, they said they've already given the buyers outlines of processes, personnel, support infrastructure. Sounds like they're aiming for a really seamless transition.
Planning ahead. Good.
Very methodical, well-planned separation, it seems.
That planning should help smooth things out post-close. They've already made some moves, like the dividend. It's down to $4.25 annualized.
Yeah, that was a key signal. Increases financial flexibility, obviously, but they gave guidance for the future, too.
What's the plan post-close?
Post-close, the intention is to grow the dividend in line with AFFO, specifically AFFO, excluding the amortization of prepaid rent. And they're targeting a payout ratio of 75% to 80%.
So a clear framework, predictable, tied to the core tower cash generation.
Exactly. Provides a roadmap for income investors.
And what about future investment needs once they're just towers? They expect to spend, $150 million to $250 million a year on net CapEx.
That's the range, yeah. For modifying towers, buying that land underneath, and that ongoing tech investment to automate and enhance systems.
Seems like a discipline level, sufficient to maintain and improve, but not excessive.
It does. And they emphasize these enhancements are already underway. They see them as fundamental to improving customer service, productivity, efficiency, basically making the tower segment best in class.
And beyond dividends and CapEx, share repurchases.
Yes. After the dividend and organic investments, they intend to use generated free cash flow to buy back shares, all while keeping that investment-grade credit rating.
Makes sense.
And management mentioned 2 stages for buybacks. First, using some proceeds from the asset sale, though the vast majority goes to debt reduction, but some for buybacks to help maintain the credit rating post-transaction.
Okay.
And second, just the ongoing use of free cash flow and leverage capacity over time. They also mentioned they're weighing programmatic versus opportunistic buybacks, still thinking through the best approach there.
Sounds like a very deliberate capital return strategy, and they reiterated that expected annual AFFO post-close.
They did. A range of $2.265 billion to $2.415 billion at the anticipated close.
That's a useful number. Gives you a sense of the earnings power of the pure-play tower business going forward.
Definitely a good anchor point for investors. Now, shifting into operational efficiencies and market insights, it's clear their focus on running the tower business more efficiently is already showing up.
How so?
Well, they've managed to drive shorter cycle times, for instance, getting applications processed and turned into revenue faster.
Ah, interesting.
And what's fascinating is that while any single improvement might be marginal, small, when you apply it across a huge volume of applications, which typically have like a 6 to 12 month cycle, the cumulative effect is significant.
Little improvements add up.
Exactly. That contributed directly to that $5 million increase in core leasing activity we talked about. Real revenue impact from just running things tighter.
So it's not just big cuts, but granular process improvements too.
Precisely. They've also improved margins in the services business by cutting operating costs. And they think those are sustainable increases, which is key.
Right.
Plus, they knocked another $10 million off the expected full year 2025 overhead costs. First, like a continuous effort, not just a one-off.
Did they give any color on how they're achieving this? Is it systems, culture, just the simplicity of being towers only?
What management communicated was kind of two phases. There are the initial first leg efficiencies, just from being a simpler, focused tower business. Less complexity.
Okay.
But beyond that, they're actively updating systems and processes now to find further efficiency opportunities. The second leg, if you will.
Ah, so more to come, potentially.
Potentially. They haven't put a time frame or a number on that yet, but the intent is clear. Build an operating model for continuous optimization. Embed efficiency into the DNA.
Makes sense. Now, what's driving the higher leasing activity overall? Is it specific carriers, new tech, specific regions?
They said it's pretty broad-based across all their major customers and across their whole footprint, really.
Okay.
The main driver seems to be wireless carriers augmenting network capacity. That's driven by subscriber growth and also increased churn, which forces carriers to invest more to keep customers happy.
So basic blocking and tackling, adding capacity to existing networks, not necessarily, say, a big rural 5G push driving it.
Apparently not primarily, no. They didn't cite specific rural builds as the main driver. More about densification and capacity upgrades on the existing grid.
Got it. Another really interesting point was their view on the 5G cycle duration. There's been some chatter, maybe 5G deployment will be shorter than 4G. What was Crown Castle's take?
Yeah, this is where their on-the-ground view is valuable. Management basically said they think it's unlikely the 5G cycle will be shorter than 4G.
And 4G was what, 10, 12 years?
Exactly, a long cycle. They even suggested 5G could be longer.
Longer? Why?
Just because of the continuously growing quantum of incremental data that needs to be handled by the networks.
Yeah.
Data demand just keeps exploding.
So it's not just about coverage, but ongoing capacity needs driven by data usage.
That's the view. It's like a marathon, not a sprint. Their direct engagement with carriers, seeing that ongoing demand, gives them confidence. It's a different perspective than some market caution you hear.
That's a significant long-term perspective. What about carrier greenfield builds? Are carriers building more towers themselves?
Crown Castle hasn't been active in that build-to-suit market recently. They just don't see the returns as favorable right now.
Okay.
And fundamentally, they find it unlikely carriers can consistently achieve a lower all-in cost over an asset's life compared to a shared infrastructure provider like them. The sharing economics just work better.
Plus, carriers often end up selling those towers later anyway.
Right? Historically, yes.
Yeah.
That often happens. So they don't see a major shift in that dynamic threatening their model.
Okay. Did they comment on private market M&A multiples for towers? Are values holding up compared to public markets?
They noted that, private market multiples for U.S. towers have historically been higher than public market ones.
Sure.
And that dynamic hasn't really changed much.
But it doesn't affect them directly now.
Not really, because they're not out there trying to buy towers.
Yeah.
Their focus is internal right now, the divestiture, optimizing what they have. So those multiples are more of an observation than a strategic input for them currently.
Gotcha. Shifting gears to future tech generative AI, AI in general, huge buzzword. How does Crown Castle see that impacting their business?
They acknowledged it's still early days to pinpoint exact use cases that will drive tower demand.
Right.
But the general expectation, the sort of underlying belief, is that as AI provides real value, it's inevitably going to become mobile. People will want it on their devices wherever they are.
Makes sense. AI on the go.
Which could lead to a significant, maybe even exponential increase in data demand down the line. Think real-time healthcare on your phone, autonomous driving needing constant connectivity, advanced manufacturing.
So a potentially massive long-term tailwind, but not something driving leasing activity today.
Exactly. It's a catalyst to watch for sure.
Okay. What about ground lease purchases, buying the land under their towers? Any shift in focus there?
Not a significant increase in activity in the first half of 2025. But they are actively focusing on identifying opportunities to buy land where it makes financial sense, good returns, reduces their cost structure long term.
So still part of the strategy.
Yes. And they actually anticipate a slight increase in capital allocation to that program in the second half of the year. So continued strategic effort.
Good to know. Quick risk check. U.S. Cellular, there's been some news around them. What's Crown Castle's exposure?
Minimal. They said negligible exposure. So whatever happens with U.S. Cellular shouldn't materially impact Crown Castle's results.
Okay, good. That takes one potential worry off the table.
Definitely.
And tax reform. Did carriers talk about using savings for wireless investment?
Apparently, carriers have mostly indicated that tax savings are going towards fiber investments, not so much wireless infrastructure directly. But management's point was that the overall market environment, increasing data traffic, subscriber growth, churn that compels continued wireless network investment anyway, regardless of specific tax benefits. The demand itself is the main driver.
Demand trumps tax policy, basically.
Seems to be the view.
Okay, one last key point. The CEO search. Dan Schlangeganger is interim. What's the status on finding a permanent leader?
They said the board is actively searching. Importantly, they're not waiting for the fiber deal to close to make a hire.
Trying to reduce uncertainty.
Exactly. Aiming to find the right person quickly. And the board have a very clear mandate for the new CEO.
Which is?
The company will be a tower-only business focused on the U.S.
Yeah.
The new CEO has to align with that vision and focus on making Crown Castle the absolute best operator of U.S. towers, period.
Crystal clear strategy. No ambiguity there.
None at all. It's a strong signal about the future direction.
So for you, our listener, when you pull all this together, this deep dive really highlights Crown Castle's decisive strategic pivot. They are going all in on being a pure play U.S. tower operator.
Yeah, it signals a really clear focus, a commitment to maximizing shareholder value through, well, operational efficiency, disciplined capital allocation, that means dividends and buybacks, and just leveraging that seemingly endless demand for wireless infrastructure.
Exactly. And those discussions around, the potential for a longer 5G cycle plus the eventual impact of AI, they offer some pretty compelling insights into the long-term tailwinds for this kind of business, suggest a durable revenue stream for years to come.
Right. Understanding how they're navigating the divestiture, how they're cutting costs, how they plan to deploy capital. It gives you a much clearer picture of their competitive position and, frankly, their resilience in this telecom landscape that's always evolving.
Okay, so given everything we've talked about, that focus strategy, the potentially longer 5G cycle, the AI data boom on the horizon, it kind of makes you think about how investors might play this, right? Which brings us naturally to our wild yet plausible trade idea segment. And remember, folks, this is purely illustrative, definitely not financial advice.
Absolutely not financial advice, but an interesting thought experiment.
Okay, how about this? The pure play connectivity pair trade.
Ooh, I like the sound of that. Go on.
So you go long Crown Castle, you're betting on that streamlined focus, the efficiencies kicking in, and just the compounding demand for towers as mobile data keeps exploding with AI and everything else.
Makes sense. Betting on the specialist. What's the other side of the pair?
Simultaneously, you consider a short position on, say, a legacy diversified telecom company. One that still owns maybe substantial non-core or subscale wireline assets, maybe one that's struggling to divest or optimize those non-tower parts of the business.
Ah, okay. So long the focused tower play, short the potentially slower moving diversified incumbent.
Exactly. The thesis is that capital investment dollars will increasingly flow towards these specialized, high-return infrastructure plays like pure-play towers.
While the conglomerates may be saddled with capital-intensive, lower-growth legacy bits, face increasing headwinds, maybe valuation discounts.
Precisely. Making Crown Castle's focused strategy look like the potential winner in the long run. It's really a bet on infrastructure specialization versus diversification.
Interesting concept. Pure play versus the field.
So just to sum up our main takeaways here, Crown Castle is executing a very clear strategy. Sell fiber and small cells, sharpen the focus on being the top pure play U.S. tower operator.
And the latest earnings, Q2, they showed solid operational progress, led to increased guidance for 2025, plus a disciplined approach to capital allocation aimed right at enhancing shareholder returns.
And that long-term outlook for tower infrastructure, it still looks robust, doesn't it? Underpinned by that relentless demand for mobile data and this evolving, potentially extended 5G cycle.
Seems that way, yeah.
Huh.
Lots of tailwinds.
Well, thank you for tuning in to this deep dive. We really encourage you to reflect on how these insights might impact your own investment thesis for the telecom infrastructure space.
Definitely food for thought. And remember, this discussion is purely for informational purposes. It is not financial advice.
We always welcome your thoughts or any follow-up questions you might have. Until next time, keep digging for those insights.